Every time someone checks your credit, it's called a credit inquiry. It sounds simple enough, but here's the thing. Not all credit inquiries are created equal. Some are completely harmless, while others can actually lower your credit score. Understanding the difference between a soft inquiry and a hard inquiry is one of the easiest ways to take control of your financial health. So let's break it down. A soft inquiry happens when your credit is checked in a way that doesn't involve you applying for new credit. Think of it as someone casually glancing at your credit profile. No commitments, no consequences. The most common example is checking your own credit score. Whether you're using a free app, your bank's online dashboard, or one of the major credit bureaus, that check is always a soft inquiry. It will never hurt your score, so there's no reason not to keep tabs on it. Another common one is pre-approval offers. You know those letters you get in the mail saying you're pre-approved for a credit card? The company ran a soft inquiry to see if you might qualify. You didn't ask for it, and it doesn't affect your score at all. Employer background checks are soft inquiries too. Some employers will review a version of your credit report as part of the hiring process, especially for roles that involve handling money. Again, completely harmless to your score. The key takeaway here is that soft inquiries are invisible to lenders. They show up on your personal credit report, but no one else can see them, and they have zero impact on your credit worthiness. Now, a hard inquiry is a different story. This happens when you formally apply for credit. A mortgage, a credit card, an auto loan, a personal loan, even a new cell phone plan in some cases. When you sign that application and give a lender permission to pull your credit, that's a hard inquiry. Unlike soft inquiries, hard inquiries are visible to anyone who checks your credit report. They signal to other lenders that you're actively seeking new credit, and that matters because, statistically, people who open several new accounts in a short period of time are considered higher risk. So let's put the two side by side. A soft inquiry does not require your permission and does not affect your credit score. A hard inquiry requires your explicit authorization and can temporarily lower your score. Soft inquiries are informational. They're about awareness, not action. Hard inquiries are transactional. They're tied to a specific application for credit. If you're just browsing, that's soft. If you're applying, that's hard. It really is that straightforward.
Here's the part that worries most people.
A single hard inquiry will typically lower your credit score by about 3 to 5 points. That's it. For most people with decent credit, that's barely noticeable. The real concern comes when you have multiple hard inquiries in a short period. If you apply for 5 credit cards in 1 month, lenders start to wonder, why does this person need so much credit so quickly? That pattern can lower your score more significantly and may cause lenders to deny your applications. Now, there is an important exception. If you're shopping for the best rate on a mortgage, auto loan, or student loan, the credit scoring models are smart enough to recognize that. Multiple inquiries for the same type of loan within a 14 to 45-day window, depending on the scoring model, are typically grouped together and counted as a single inquiry. So don't be afraid to shop around for the best rate. The system is designed to let you do that. Hard inquiries stay on your credit report for 2 years. However, most scoring models only factor them into your score for the first 12 months. After that, they're still visible, but essentially meaningless. And after 24 months, they disappear entirely. Soft inquiries, by comparison, may stay on your personal report for a year or two, but since they don't affect anything, there's really no reason to worry about them. So how do you manage your credit inquiries like a pro? Here are a few practical tips. First, only apply for credit when you actually need it. Every hard inquiry is a small dent, So don't apply for store cards on impulse just to save 10% on a single purchase. Second, do your rate shopping within a focused window. If you're comparing mortgage or auto loan offers, try to submit all your applications within a 2-week period so they're bundled as one inquiry. Third, check your credit report regularly. Soft inquiries are free and harmless, so use them. Monitor your report for errors, unauthorized hard inquiries, or signs of identity theft. You're entitled to a free report from each major bureau once a year at annualcreditreport.com. Fourth, if you see a hard inquiry you don't recognize, dispute it. Unauthorized inquiries could be a sign of fraud, and you have the right to have them investigated and removed.
And finally,
Keep perspective. A single hard inquiry is not going to ruin your credit. What matters far more is your payment history, how much of your available credit you're using, and the overall age of your accounts. Inquiries are just one small piece of a much bigger picture. At the end of the day, credit inquiries are one of the simplest parts of your credit profile to understand and manage. Soft inquiries are harmless. Hard inquiries are minor and temporary. The key is being intentional about when and why you apply for new credit. Stay informed, check your score often, and don't let fear of inquiries stop you from making smart financial moves. Knowledge is your best tool, and now you've got it.